Okay, let's unpack this. Imagine dedicating years to mastering a complex field, earning top degrees, absorbing every expert opinion, only to find yourself struggling where, well, 90% of others also fail.
It's a pretty common story, unfortunately.
Right. So our deep dive today is into a fascinating set of sources that challenges everything you thought you knew about success, especially in the high-stakes world of financial trading.
Yeah, it's really not about being the smartest or even being right most of the time, which is
Oh,
kind of surprising.
exactly. Our mission today is to explore a radically counterintuitive idea. The best loser wins.
The best loser.
Okay. So the author of our core material, his journey began really young, just 10 years old, completely captivated by the markets.
Oh, 10.
Yeah, pursued them like a, quote, love-struck teenager, got 2 university degrees, studied Nobel laureates, Fibonacci ratios, Bollinger Bands, you name it, he looked into it.
So the whole academic route, all the standard tools.
Totally. He even developed models of the tide swell in the Hudson River, trying to find some kind of pattern, trying to dance with the market's rhythm.
That's dedication. Or maybe obsession.
Maybe a bit of both. But as he discovered, the market just isn't an equation you can solve. It's far more complex than any single model can capture.
And what's truly fascinating here is how this initial, very intelligent fascination led him down a path that, well, many of us might recognize. Seeking answers in external models, established theories.
The usual suspects.
Exactly. He actually wished someone had just told him, like, don't bother with all that. Because the markets consistently defy that kind of simple capture.
Which really begs the question then, if traditional wisdom, like a lot of technical analysis, isn't the key, why do so many gurus still peddle it, as the ultimate solution?
That's a billion-dollar question, isn't it?
Well, the sources have a pretty scathing critique of these expensive weekend courses. Says they're often filled with regurgitated material, offering very little original thought.
In there, seen those ads.
Right. These gurus portray trading as easy, they flaunt the private jets, and crucially, they never reveal their losing trades. It creates this illusion that losing is just, I don't know, a minor inconvenience.
And that facade, as the author points out, it sets up aspiring traders for some really profound internal conflict later on.
Exactly.
Yeah, if we connect this to the bigger picture, it just highlights a fundamental disconnect.
Right.
People are often taught these specific tactics like how to scalp or how to use Man-C. That's a common momentum indicator for those listening.
How-tos.
But the core problem, and this is what the author found when he was at City Index looking at millions of trades, it isn't really a lack of technical knowledge. In fact, he found most people who open trading accounts are intelligent. They're ambitious, self-motivated individuals. So if they have the drive and often the basic tactical knowledge, what exactly is going so wrong? Why the widespread failure?
Well, the numbers he shares are pretty stark. There's a European law, apparently, that mandates brokers disclose client failure rates.
Oh, interesting. I didn't know that.
Yeah, and they consistently show 70 to 90% of retail clients lose money.
70 to 90%.
Wow, think about that. This is despite incredible advancements in trading tools, lower spreads, more accessible information than ever before.
So all the external stuff has gotten better, easier, cheaper, but the results haven't.
Pretty much.
Yeah.
It forces us to ask, where does the true bottleneck lie? What is the real problem that all this external knowledge isn't fixing?
Okay, so it's not the tools, not the basic knowledge.
Right. And here's where our deep dive starts to get really provocative. Our sources suggest that the core issue is simply being, well, normal.
Normal.
Yeah. If you think like everyone else, you'll get the same results as everyone else. And in trading, according to this, that means losing.
Okay, that's a bold claim. Normal is a loser.
It is bold, isn't it? It goes against so much of what we're taught about being prudent or, careful in life.
It is, but the author provides some compelling evidence. He describes common behaviors rooted in what he calls the supermarket mentality.
Supermarket mentality, okay.
Think about it. In a supermarket, falling prices are seen as bargains, right? Like half-price toilet paper, you grab it.
Sure, makes sense.
So traders apply this logic to the market. They try to catch the falling knife, buying assets whose prices are plummeting. But this is like diametrically opposed to effective market behavior.
So.
Well, in markets, a falling price often indicates continued weakness, not value. It's not a bargain. It's a warning sign.
Okay.
He tells this chilling story from Royal Ascot, the horse race event. He told clients Marconi stock was, quote, garbage.
Ouch. Risky move.
Totally. He actually got fired for that honesty, but he saved fortunes for those who listened because the stock eventually went to zero.
Wow.
So his point is our ingrained consumer behavior, the normal way of thinking, it actively sabotages us in the markets.
That's a powerful example. And you listening might be thinking, okay, but how can I tell if I'm doing this? Am I falling into these normal traps? The author gives us some pretty powerful, quantifiable evidence here.
Yeah, he cites a study of 25,000 FX traders. They executed 43 million trades. Now get this, 62% of those trades were profitable.
62%, that sounds great, right?
It does, on the surface.
Yeah.
But the average win was only 43 pips. A pip is just a standard unit for currency pairs, while the average loss was a staggering 78 pips.
78, so nearly double.
Exactly. So if you're winning more than half the time, but you're still losing money overall, what does that tell you about your ability to handle the losses?
It suggests you're maybe cutting winners short and definitely letting losers run way too long.
Precisely. It points to a profound struggle with just acknowledging when you're wrong and cutting bait.
And it's not just about acknowledging losses, is it? The author points to how our very minds, our brains, misinterpret information.
Yeah, he uses optical illusions, which is quite clever, like the checkerboard shadow illusion, where squares A and B look like different shades, but they're actually identical.
Oh yeah, I know that one. Your brain insists they're different.
Right. Or reading the word red, written in blue ink. Your brain wants to say blue, even though the word is red. These examples show how our brains jump to conclusions. They override objective observation.
You have to consciously stop your brain's automatic response.
Exactly. And this isn't about intelligence. That's the key thing. It's about our hardwired human nature. Our minds really struggle to separate the world of trading from general consumer behavior, where, chasing bargains and taking profits early are often rewarded.
It's like two different operating systems.
Kind of. He even recalls the legendary story of an Englishman who made £8 million, identifying the French franc as overvalued before Black Wednesday. Huge win.
Right, famous trade.
But then he lost it all. Why?
Mm-hmm.
Because he didn't understand how winning changes your brain chemistry. It leads to overconfidence, poor decisions.
So the win itself became the seed of the loss.
Yeah, it demonstrates this deep-seated cognitive dissonance, that really uncomfortable feeling when your actions don't align with your goals, or when your gut tells you one thing but the data's screaming another. It's a massive barrier. Yeah.
But there's a way through it. You mentioned Tiger Woods.
Right, Luke Donald, another golfer, said Woods wasn't necessarily technically better than everyone, but he had this amazing ability to forget mistakes instantly.
Yeah.
Bad shot. Forget it. Move on to the next one. That mental reset is key.
That ability to reset, to not let past mistakes poison the next moment. That's truly powerful. So, okay, if conventional wisdom and our natural human instincts are actually leading us to fail, what's the alternative? How do we break free from this normal is a loser cycle?
Well, the answer, according to these sources, it's inside you.
Inside, not another indicator or system.
Nope. It comes down to this phrase: the best loser wins.
The best loser wins.
Yeah.
It's fascinating, but honestly also incredibly difficult to internalize, I imagine. Especially for someone who's already losing, the idea of embracing more loss feels, well, counterintuitive to survival, right?
Yeah.
How do you even start to reconcile that fear?
It really is a profound shift in perspective. It's like a complete mental rewiring. It means cultivating a mind that can lose without anxiety, without that emotional attachment or resentment or the desire to get even with the market.
Which is so hard when money's involved.
Oh, absolutely.
Yep.
It really means knowledge of yourself, not just technical analysis, is what sets you apart. The ability to take a loss, accept it, and move on immediately. That's a cornerstone of this mindset.
So it's about fighting your own human nature.
Yeah, fighting your humanness, as the author puts it. He found traders are perpetually hopeful when losing spibbles. They cling to positions that are clearly going south.
Hoping it'll turn around.
Right. And then they're fearful when winning, taking profits way too early because they're scared it will disappear.
That cognitive dissonance again.
Exactly. This internal struggle between what feels right instinctively and what actually works in the market, that's the real enemy. It's like the Tiger Woods example again. That discipline to not let emotion dictate the next action.
Okay, I get the concept. The author even describes his own book of truths, a PowerPoint of his past trades, charting every entry and exit.
Yeah, brutal honesty with himself.
He said it tormented him, exposing his disastrous decisions, but it acted as a positive catalyst for change. It was his way of confronting his flaws head on. So, For those of us listening wanting to cultivate that kind of mental discipline, what are the concrete steps, the actionable stuff, to embrace this best loser mindset?
Okay, yeah, let's break down the actionable insights from the sources. The first one is basically embrace loss.
Embrace it. Still sounds scary.
It does, as you said, but it's about recognizing that accepting a loss quickly actually frees your mind up for new opportunities. It's often the avoidance of that pain, that small loss, that keeps traders trapped in much bigger losing positions. It's a mental release, in a way.
Okay, so it's not about seeking losses, but about acknowledging them fast and letting go without the drama. That's a crucial distinction. What's next?
Exactly. The second insight is to add to winners.
Add to winners, not just let them run.
Right. Legendary traders like Charlie DeFrancesca, they don't just cut losses and let winners run. They actively add to their winning positions.
But isn't that terrifying? Putting more money at risk when you're already up.
It's incredibly counterintuitive to our normal behavior, yes. The fear of losing those accrued profits makes us want to scale back or cash out too early. But the author shares this story of a South African hedge fund. They only had a 25% hit rate.
Only winning 1 in 4 trades.
Yeah, but they were wildly successful. Why? Because their winning trades absolutely dwarfed their small, quickly cut losses. They often aim for like a 25x profit relative to their initial risk. They weren't afraid to press their bets when a trade was working.
That really does flip the script. Instead of being scared of losing what you've gained, you're leaning into the success. Okay, what's number 3?
Third is to define risk, not reward. This is fundamental. You can only control how much you risk on any given trade. You absolutely cannot control how much the market will give you. Losers, he says, spend their time dreaming about how much they will make. Winners focus obsessively on how much they could lose if they're wrong, and they manage that ruthlessly.
So you shift your focus from an uncontrolled variable, the profit, to a controlled one, the potential loss.
Precisely. It's a complete reframing. It's all about managing the downside first, and then letting the upside take care of itself if it happens.
Okay, that makes sense. That's about control. What's the core mental training involved in actually doing this?
Well, that brings us to the fourth point, which is kind of the core of it. Flip the switch.
Flip the switch.
Yeah, this is the real mental training. The default assumption needs to change. Assume you are wrong until the market proves you otherwise. Expect to be uncomfortable. Trading well isn't supposed to feel easy or natural.
So embrace the discomfort.
Yes. Add when you are right. Never add when you are wrong. Simple rule. Incredibly hard to follow. It means when the market goes against you, you close the position, accept it, move on. No averaging down.
Get out clean.
Right. And when it goes in your favor and you feel that fear creeping in, that urge to grab the profit, that's precisely when you should look to potentially make the position bigger, defying that gut instinct.
So it's about actively conditioning yourself to do the opposite of what feels natural. Building new mental reflexes, almost. What kind of practices help cement these changes? Are there exercises?
There are. Fifth point. Mental warm-ups are crucial. He talks about daily visualization, much like Philippe Petit, the tightrope walker you mentioned.
The guy who walked between the Twin Towers.
That's the one. Petit would mentally rehearse the walk, apparently exaggerating his fears in his mind, so that the actual event felt almost mundane by comparison.
Interesting tactic.
Yeah, so traders can visualize trades, visualize handling losses calmly. It also involves things like breathing exercises to calm the amygdala. That's the brain's fear center.
Right, the fight or flight response.
Exactly. And regularly reviewing past bad trades. Not to beat yourself up, but to learn the patterns, the triggers, and avoid repeating those specific mistakes. It's about building new neurological pathways to counteract our default programming.
That's fascinating, treating your brain like a muscle that needs specific training and warm-ups before you ask it to perform under pressure. Okay, and finally, what's the last key insight?
Lastly, number 6 is patience. Just patience. The author highlights Navinder Sarao, the trader implicated in the flash crash, as an example of incredible patience, despite his other issues.
How did he practice patience?
Part of his practice involved deliberately expanding his field of information. He'd review charts on multiple time frames, daily, weekly, monthly views, specifically to slow down his decision-making process.
Ah, so widening the perspective stops impulsive reaction.
Exactly. It allows for a more considered, less emotional approach. Less reacting, more responding based on a bigger picture.
Okay, so bringing this all together, what does this all mean for you, our listener? This deep dive really reveals that consistent trading success, it seems, isn't about finding that perfect indicator or some secret strategy someone's selling.
No, it's clearly an inner game.
Yeah.
It's a battle against your own hardwired human nature.
Yeah, the author's own journey is pretty telling, from getting fired for being honest about a stock to eventually achieving a 7-month winning streak after this kind of mental transformation. It's a powerful testament to becoming, well, good at losing.
Indeed, the paradox is profound, isn't it? By doing what the 90% cannot or will not do, confronting fear, embracing discomfort, managing losses ruthlessly, that's how you potentially become successful.
It means training your mind constantly to act dispassionately, to see information purely from an opportunistic viewpoint rather than an emotional one.
Right. As the author puts it, it isn't the lack of knowledge that's stopping you from winning big. It's the way you handle yourself when you are in a trade.
It's about your beliefs, that internal dialogue, and your willingness to make those daily, conscious choices that often defy your natural instincts.
Absolutely. It's work.
Yeah.
Constant work.
Which leaves us with a provocative thought, I think. If 90% of traders fail because they're looking in the wrong place, outside themselves, for answers, how much of your own potential, maybe in trading or maybe in any area of your life, are you leaving untapped by not looking inward, by not taking control of your own mental game?
That's definitely something worth pondering.
It is. Until next time, keep diving deep.